Fubo stock is down over 60% in the past 2 weeks. Now, it's been a wild ride for Fubo shareholders in the past month, as it's all increased from about $26 all the way up to $62 after Needham's analyst Laura Martin upgraded its price target from $30 to $60. After a few short seller reports, this stock had a huge fall from grace and is now sitting below its price before Laura Martin upgraded its price target. So what I want to do in this episode is talk about what's happening with Fubo TV, break down what the company is all about, and talk about what I will be doing with this stock. So I first wanted to address why I'm looking into Fubo TV. So other than the fact that I saw a huge rise and fall in this past month, the reason I want to look into Fubo TV is because it reminds me a lot of Roku when it IPO'd in late October 2017 at about $20. Now, after that year, it saw a nice little run up to about $70, to which it saw bad earnings, and the stock tumbled after the company reported financial results that included projected fourth quarter losses that were wider than Wall Street expected. The stock took a nosedive and went to a low of about $27. Despite the fact that Roku kept growing, investors didn't like the profit outlook, and that's why the stock was selling off so hard. Now, if you were a believer in Roku and bought then, you'd be up over 10x your money today. Roku, as of January 4th, 2020 run, trades about $330. That really goes to show you the power of investing in a company that you believe in after it's taking a beating because of a few different quarterly reports. I think Fubo is a really interesting company, and if it does execute or even exceed its own expectations, I believe it could be the next big multi-bagger. So let's first break down what Fubo TV is all about. So Fubo TV is a leading sports-first live TV streaming platform offering subscribers access to tens of thousands of live sporting events annually, as well as leading news and entertainment content. They stream 90% of nationwide NFL games, with the majority of the country receiving all games, and have strong coverage of other nationally televised leagues. They have 100% of the NHL, 88% of the MLB, and nearly 70% of the NBA. Now, they claim to be the only MVPD, or virtual multi-channel programming distributor, streaming in 4K, including 11 Thursday night football games this season and the recent 2020 World Series. Fubo TV also has more regional sports networks in its base package than any other live TV streaming platform. So to put it simply, Fubo TV is a sports-focused live TV streaming platform. Now, Fubo's TV leadership believes that they sit firmly at the intersection of three industry megatrends: the secular decline of traditional TV viewership, the shift of TV ad dollars to connected TVs, and online sports wagering. Their strong subscriber growth indicates consumers are cutting the cord faster than ever before, and their increased viewer engagement has driven Fubo TV's ad sales and growth. Now, just recently, Fubo TV announced that they intended to expand in the online sports wagering market. Their goal with wagering is to develop a new revenue stream for Fubo TV, and one of which they believe will be an important contributor to their underlying business. Fubo TV has an opportunity to combine sports wagering services and a leading live sports streaming package. In addition to sports, they continue to grow their news and entertainment offerings, as they just announced that they have new content agreements with Epix and Stars, and will continue to launch premium entertainment channels on Fubo TV throughout the year. This broad mix of content is why their consumers come for the sports and stay for the entertainment. So as we've seen in the last month, with its insane run up to $60 and its quick fall from grace, Fubo TV has quickly become very polarizing, with a lot of bulls and bears. Now, Fubo's stock absolutely skyrocketed as analysts continue to raise their targets, with Needham's Laura Martin raising her target to the street high $60 on December 22nd. However, on the very next day, Lightshed's Rich Greenfield defied the crowd, saying Fubo might be the most compelling short we have ever identified in our career as analysts, giving the stock an $8 target. So who's right? With Fubo having soared as high as $62, but now trading at over 60% of a discount at $24 as of this episode, what should investors do with the stock? Well, let's first talk about the case for $60. Now, Fubo's growth numbers look pretty impressive. Last quarter, the company grew its subscriber count 58% to 455,000, with average revenue per user increasing 14% year over year. It also showed a total adjusted revenue growth of 71% to $61 million. Now, average monthly active user hours streamed increased 20% to 121 hours per month. Importantly, advertising revenue increased even more, up 153% to $7.5 million. The cost side seems to be improving as well, with the company logging a positive adjusted contribution margin of 16.5% and a decline in subscriber acquisition costs. Now, Martin based her $60 price target on several different factors, including that Fubo TV is taking share from its competitors, short covering, lower subscriber acquisition costs thanks to its HeSense partnership, upside from sports betting, over-the-top expansion, and connected TV upside. From the looks of it, Fubo looks like an excellent growth stock, firing on all cylinders and benefiting from the rise of streaming, right? Well, not so fast, says Greenfield. Now, after Fubo TV's epic run this year, it's probably a good idea for all investors to understand the bear case as well. First off, Fubo TV isn't really differentiated from its peers YouTube TV or Hulu Live. In fact, though it bills itself as a sports MVPD, it carries fewer channels, especially since it dropped Turner's network that holds MLB playoff games, the NBA, and even March Madness. All the MVPDs have also dropped regional sports networks due to the cost. Sports content is really expensive, and the only way channels can scale is by adding more non-sports content. Originally built as a sports-centric MVPD, Fubo now provides an array of entertainment options similar to the others. Now, Greenfield believes that the MVPD bloated bundle will shrink, eventually ending up at around 45 million subs for the industry overall, down from the 66 million today. He also thinks that only half of the subscribing to cable bundles will transfer over to OTT streaming MVPDs. That should only leave about 23 million subs in the US. Meanwhile, Fubo still has to compete with Hulu, YouTube, and Sling, which account for about 90% of the MVPD bundles today, or 10 million out of the current 11.5 million subs. Now, that subscriber figure should double over the next 5 years or so, but since Fubo doesn't really have a differentiated product, it would be hard to steal enough market share for Fubo to really get winner-take-all growth and economics. What's more, even if Fubo doubles its market share and grows 4 times over versus 2 times over for MVPDs, that would only get it to 2 million subs. The other problem is that the MVPDs don't really make money. In fact, Greenfield expects Fubo's subscription business to be a zero gross margin business, even at maturity. I'm not sure if he meant zero gross margin or zero operating margin, but today, even after its great quarter, Fubo is still a break-even gross margin business on a GAAP basis. Subscriber-related expenses alone slightly exceeded total revenue last year, even with ad revenue included. With the rest of the operating expenses, Fubo lost $127 million in the last quarter alone. In any case, sports-related distributors always have to pay high prices for sports content, and many of those content owners force distributions to also carry other non-sports channels. It's a notoriously low-margin business, and I'm not sure why Fubo would be any different. Now, that leaves advertising, which could make up the difference. However, ad revenue only made about 12.3% of its total revenue last quarter. Fubo would have to greatly increase ad revenue going forward. Additionally, sports betting is a quote-unquote fantasy, according to Greenfield, as he noted that recently acquired Balto doesn't have a betting product, any revenue, or even a website. Additionally, many who watch Fubo in geographies that allow betting already have a sports betting app. It will be hard to build a product that stands out in a crowded field. And if that's not enough, there also may be a good chance investors aren't contemplating a correct share count for Fubo. For instance, some investing websites list a share count around 67.5 million. However, when one looks at the company's quarterly filing, there's actually a lot of options, warrants, and preferred shares that when converted would add another 92 million shares to the share count, putting the real share count in the high 150 million range. Greenfield himself uses a 157 million number, more than twice the share count listed on many websites. That means Fubo's real market cap is about 6.2 billion, not the 2.6 billion listed on many investing websites today. Now, all in all, I think Greenfield has a lot of pretty good points that we do need to take account of. Now, certain companies, such as The Trade Desk and Roku, make money from the general rise in streaming no matter what channel is a winner. Fubo, on the other hand, kind of seems just like another product in a low margin business of the MVPDs without any proprietary content. Now, if Fubo is able to differentiate in order to take more market share than Greenfield thinks, better monetizes its users, and keeps its costs down, it could be worth the current price someday. So I want to quickly go over the third quarter 2020 financial highlights. Now, revenues were $61.2 million, a 47% increase year on year, which was driven by continued subscription expansion, an increase in average revenue per user, and growth of advertising sales. Now, their subscription revenue increased 64% year on year to $53.4 million, and their advertising revenue increased 153% year on year to $7.5 million. Now, the paid subscribers at the quarter end totaled 455,000, an increase of 58% year over year. Their average revenue per user per month was $67.70, up 14% year over year. The total content hours streamed by Fubo TV in the quarter increased 83% year over year to 133.3 million hours, and their monthly active users watched 121 hours per month on average in the quarter, an increase of 20% year over year. So as of Tuesday, January 5th, 2021, Fubo just announced their preliminary fourth quarter revenue and subscriber results today. Both the metrics are expected to exceed the previously issued guidance in a record quarter and year for Fubo TV. So for the fourth quarter, total revenue is expected to be about 94 to 98 million, a 77 to 84% increase year over year. Now, the prior guidance was about 80 to 85 million. Their paid subscribers at the end of the year are expected to exceed 545,000, an increase of more than 72% year over year. Now, their prior guidance was about 500,000. Now, it's really good to see that Fubo is actually increasing their revenue and their paid subscriber count. I think this is a really healthy sign, and definitely I think this is a really healthy sign for Fubo TV, and definitely a catalyst that I can see push the stock much higher in the future. Now, digging into Fubo's income statement, you can find this in their S1 filing. We can see that their total revenues were about $61,000, with subscriptions taking up the majority of it. Now, digging into their operating expenses, we can see that their subscriber-related expenses is actually more than their total revenues as a whole. Going down the list, we can see that they have a whole bunch of other operating expenses with a total operating expenses of $363,000. Now, the $236 million impairment of intangible assets and goodwill is because they currently merged with FaceBank, and this would be a one-time expense. Now, without this one-time charge, they would have had an operating loss of about $70 million. However, with it, they had a net loss of $274 million. Now, definitely not what you want to see. I know for a lot of people that would just turn them off immediately. However, for a growing company, this is typically what you'd see. They are investing heavily into growing their revenues, and they are seeing a pretty robust revenue growth. Now, one of the things I really don't like seeing is that the subscriber-related expenses is actually more than the total revenues as a whole. What I like to see in the next coming quarters is subscription revenue to be actually higher than their expenses, and to me, that would show a clear path to profitability. Okay, guys, so we just went over Fubo the company, their product, their recent quarter, and the bull and bear case. Now, I want to give some of my insights on what I think about Fubo TV. Now, as we know, streaming has taken off in this past decade, and there's been amazing adoption of streaming in our lives. However, live TV demand is not falling by any significant amount. So Netflix as a streaming service has been around for a decade, and it's nearly ubiquitous in the US today. Now, despite Netflix being in almost every household in America today, most American households still pay for cable TV. So why is this? Well, if Netflix is fulfilling all of our entertainment desires, why are most Americans still paying over $100 per month for cable? Well, the reason is because Netflix isn't fulfilling all our entertainment desires. And to be honest, it never will. Customers love their live programming. They love live news, they love live sports, and these are all things that cable TV provides, which Netflix won't. Now, I believe this next decade won't involve households cutting cords and replacing cable TV with nothing. Now, instead, the next decade will involve hundreds of millions of households cutting the cord and replacing cable TV with live TV streaming services. Since streaming services are much cheaper, easier to install, easier to maintain, and more convenient. Now, Fubo TV is definitely at this epicenter of the shift. However, it is facing quite a bit of competition. While Fubo TV is largely undifferentiated from YouTube TV and Sling TV today, It pays to remember that Netflix was undifferentiated with Amazon Video in its early days too. Netflix acquired and created original content, created a moat, and leveraged that moat to differentiate itself from its pack. That differentiation attracted new subs to the platform and created a super sticky user base that fell in love with exclusive content. Now the question is, will Fubo TV do the same over the next few years? Well, the company is already in talks to acquire exclusive programming rights to sports content, and management appears strategically focused on creating a sports-first streaming platform that is differentiated through exclusive sports content. Now, this could really be Fubo's TV moat, and in turn, leverage the moat to differentiate itself from YouTube TV and others. Now, if they are able to do that, I could definitely see the path where they are able to grow their subscriptions count. Now, if they are able to scale to about, let's say, 10 million subs, it is able to drive significant leverage through the company's operating model. With that leverage, Fubo TV could follow Netflix's footsteps and in turn turn its operating losses into operating profit. Now, the more Fubo TV drops, the more compelling of an investment it is to me. Now, I currently have no shares in Fubo TV. However, I am looking at it pretty intensely. I believe if you are investing in Fubo TV, it is going to be a very long-term investment. Fubo's financials are not looking that good right now. And for good reason. It's spending a lot into growing its subscription count and to expand into other areas. Now, if you invest in Fubo TV today, what you're really saying is that Fubo will continue to grow, will gain market share, and will have a path to profitability in the future. Now, competition is really tough, and I think it's really important to understand the kind of low margin business that they're in right now. However, if they are able to capitalize on their sports betting and are able to integrate it within the Fubo app, and it gets a lot of adoption, it could be a big winner. Now, that's a lot of ifs. So I really encourage you to look into this company yourself, really understand the business model, and really understand where its future prospects are. So all in all, I think Fubo at these prices are a pretty compelling investment. So you guys heard both the bull and the bear argument. Now, I do think there's a lot of risk factors with this stock that you guys do need to take account of. Now, you need to take a look at their business model, which is clearly losing a lot of money. Now, they are growing pretty healthily. However, I do think it's really important to understand their path to profitability. They are working in a very competitive space, and only time will tell if Fubo will continue to gain market share in this area. I think the valuation of this company is pretty attractive. However, its current financials aren't looking too pretty. I really like the fact that they did acquire the sports betting company and they are planning on integrating it into their app. However, I wouldn't look too much into that. What you want to look at is the underlying business right now, which is essentially their live TV. Now, I like the fact that they're focusing more on sports. Now, as a personal anecdote, my dad and I have been watching a lot more sports together, and it's been something that we've really been enjoying while we stay at home. I can definitely see a lot more people wanting to watch more sports and would be willing to actually pay for sport. I like the fact that they're seeing pretty robust revenue growth, and they're projected to see even better revenue growth in the future. However, as of right now, their financials are a little messy, so that's why I'm gonna just put this on my watch list and kind of see where it trades over the next few weeks. All right, guys, thanks for sticking around for my breakdown of Fubo TV, what's happening about the company and its long-term future. If you guys are interested in more content like this, go ahead and hit that subscribe button, smash that like button for the YouTube algorithm, and let me know in the comment section down below what you guys think about this company or what you guys are gonna be doing. All right, guys, I'll see you in the next episode, and let's go get that bag.